Nobody told you investing would feel like this at 40. You've worked hard. You've paid bills. You've survived things you don't talk about at dinner. And now you're sitting here, wondering if you started too late, or if you've been doing it all wrong. Maybe you have a little saved. Maybe you have nothing. Maybe you have something, but you're not sure if it's enough or if it's in the right place, or if the people managing it actually care about you. That feeling, that quiet unease, it's not weakness. It's wisdom starting to wake up. Because investing after 40 isn't the same game they sell to 25-year-olds. The rules are different. The risks are different. And the truth nobody wants to say out loud? Most of the advice out there wasn't written for you, but this conversation is. So let's slow down, strip away the noise, and talk about what investing actually looks like when you have something real to protect and real time left to make it count. Let me ask you something. When you were younger, maybe in your 20s, maybe early 30s, did anyone sit you down and explain investing in a way that actually made sense for your life? Not a seminar, not a YouTube ad, not a coworker who just discovered index funds and wouldn't stop talking about them. I mean someone who really looked at you and said, here's what you need to know, given where you are. For most people, that conversation never happened. Instead, we got fragments. A 401k enrollment form at a new job. An article we half read about the stock market. A financial advisor who spent more time talking than listening. And somewhere along the way, we made decisions, or avoided making them, based on incomplete information and a quiet hope that it would all work out. Here's the first thing I want you to hear today. That's not your fault. The financial industry wasn't built to educate you. It was built to sell to you. And there's a significant difference between those two things. When someone is trying to sell you something, they simplify. They make it sound urgent. They use words like opportunity and growth and portfolio optimization, words that sound smart, but leave you more confused than when you started. You nod, you sign, and you walk away not entirely sure what just happened. That's by design. But here's what happens when you reach your 40s with that kind of financial education. You start to feel behind. You look at retirement calculators and feel a knot in your stomach. You hear people talking about their investment returns, and you smile and say nothing, because you're not even sure what you're invested in right now. And that silence, that gap between what you know and what you feel like you should know, it becomes its own kind of weight. I've talked to so many people in this exact place. Smart, capable, hard-working people who built real lives and somehow still feel like beginners when the conversation turns to money. So before we talk strategy, before we talk accounts or assets or allocation, I want to say this clearly. You are not behind because you were careless. You are behind because no one gave you the map. And that changes today. The good news about investing after 40 is this. You still have time. Real time. Meaningful time. The math still works in your favor, not the same way it did at 25, but in a different way that actually suits where you are in life. Because at 40, you have something most 25-year-olds don't. You have clarity. You've lived enough to know what actually matters to you. You've made enough mistakes to know what you won't do again. You understand risk in a way that's personal, not theoretical. Because you've felt it. You've lost something or come close to losing it, and that experience changes how you see money. That's not a disadvantage. That's one of the most powerful things you can bring to an investment strategy. The problem isn't your age. The problem is that most financial advice is still written as if you're starting from zero, with decades ahead and nothing to lose. But you're not starting from zero. You're starting from experience. And experience, when you learn how to use it, is worth more than an early start. In the next few minutes, we're going to get into the specifics, the actual strategies, the accounts, the decisions that matter most after 40. But I wanted us to start here, with the truth. Because if you don't believe you can do this, none of the tactics will stick. So believe it. not because I'm telling you to, but because the evidence is already inside you. Let's talk about something real. When most people think about investing, they picture the stock market, a ticker tape running across a screen, numbers going up, numbers going down, someone in a suit making confident predictions on television. And maybe that image makes you feel a little distant from the whole thing. Like investing is something that happens to other people, people with more money, more knowledge, more time to sit and watch charts. But here's what investing actually is, at its core. It's the decision to put your money to work instead of letting it sit still. That's it. That's the whole idea. You take money you've earned, and instead of spending it or leaving it in an account earning almost nothing, you place it somewhere that has the potential to grow, slowly, steadily, over time. Now, why does 40 matter? Because at 40, you likely have somewhere between 20 and 30 years before you'll need to live off of what you've built. That's not a short runway. That's a long one. Long enough for compound growth to do real, meaningful work on your behalf. Let me give you a simple picture of what that means. If you invest $500 a month starting at 40, and that money grows at an average of 7% per year, which is a conservative estimate for a diversified stock portfolio over time, by the time you're 65, you'd have somewhere around $380,000, not a fortune, but real money. Money that could cover years of living expenses. Money that, combined with Social Security and any other savings, could genuinely change the texture of your retirement. And if you already have some savings built up, even $20,000, even $50,000, the math gets more interesting from there. The point isn't the exact numbers. The point is this: time is still working for you. Quietly, invisibly, the way it always has. The question is just whether your money is working alongside it. Now, what should you actually invest in? This is where people get overwhelmed. There are thousands of options: individual stocks, mutual funds, ETFs, bonds, real estate, annuities, commodities. And every financial channel on the internet has a strong opinion about which one is the right one. Here's what I'll tell you, and I want you to hold on to this. Simple almost always beats complicated. For most people investing after 40, especially those who don't want to spend hours managing their portfolio, a straightforward mix of low-cost index funds is one of the most reliable strategies available. Index funds don't try to beat the market. They track it. They hold a little piece of hundreds or thousands of companies, so when the market grows over time, you grow with it. They're not exciting. They don't make for great dinner conversation. But over decades, they quietly outperform the vast majority of actively managed funds because they have lower fees, less guesswork, and a simple logic that holds up over time. Warren Buffett, arguably the most successful investor in American history, has said repeatedly that index funds are the right choice for most everyday investors. Not because they're the most sophisticated option, because they work. And for someone at 40 who wants to build wealth without making investing a second job, that matters. There's one more thing I want to say before we move on. Investing after 40 isn't just about accumulation. It's about protection too. At 25, you can take more risk because you have time to recover from losses. At 40, you need to start thinking about balance. How much risk you can genuinely afford to carry, and how much stability you need to sleep at night. That balance is personal. It depends on your income, your debt, your family situation, your goals. But the conversation has to start somewhere. And this is where it starts. With the understanding that you're not trying to get rich fast. You're trying to build something real, something steady, something that will still be standing when you need it most. That's a different goal than what the financial media usually talks about. And it requires a different kind of thinking. Let's get specific. Because at this point in the conversation, you might be nodding along. And that's good. But nodding isn't enough. What I want is for you to finish this video and feel like you know exactly where to start or where to go next. So let's talk about accounts. Because before you invest a single dollar, you need to understand where that dollar lives and why it matters more than most people realize. The IRS gives you options. And after 40, knowing which ones to use and in what order can mean the difference between building real wealth and leaving thousands of dollars on the table. Let's start with the one most people already have, or have access to. The 401k. If your employer offers one, this is usually your first move, especially if they offer a match. An employer match is the closest thing to free money that exists in the financial world. If your company matches 50% of your contributions up to 6% of your salary, and you're not contributing at least 6%, you are walking away from compensation you already earned. Stop walking away from it. In 2024, you can contribute up to $23,000 to a 401k if you're under 50. But here's the part that matters for you. Once you turn 50, the IRS allows what's called a catch-up contribution, an extra $7,500 per year on top of that limit. That's $30,500 annually, sheltered from taxes, growing for your future. That catch-up provision exists because Congress understood something. Life doesn't always go according to plan. Some people are ready to invest seriously at 40, 45, 50, not at 25. And the tax code, in this one area at least, acknowledges that. Use it. Next, the IRA Individual Retirement Account. There are two main types, and the difference between them is about when you pay taxes. A traditional IRA lets you contribute pre-tax dollars now, reducing your taxable income today. You pay taxes when you withdraw the money in retirement. A Roth IRA works the opposite way. You contribute money you've already paid taxes on, but then it grows tax-free. And when you retire and start withdrawing, you pay nothing. For many people in their 40s, especially those who expect to be in a similar or higher tax bracket in retirement, the Roth IRA is quietly one of the most powerful tools available. Tax-free growth for potentially 20 or 25 years is not a small thing. It's a significant thing. The contribution limit for IRAs in 2024 is $7,000 per year. With catch-up contributions after 50, that rises to $8,000. Now, there are income limits for Roth IRA contributions. If you earn above a certain threshold, your ability to contribute directly to a Roth phases out. But there's a legal strategy called the backdoor Roth IRA that can work around this. It's worth looking into with a qualified tax professional if you're in that situation. I say that because I want to be honest with you. I'm not your financial advisor. I'm not going to tell you exactly what to do, because I don't know your full picture. What I can do is make sure you know what questions to ask and what options exist, because most people don't ask. They assume investing is complicated, defer to whoever sounds most confident, and end up in products that benefit someone else more than them. Knowing the landscape changes that. There's a simple order of operations that many financial planners recommend for people building wealth after 40. First, contribute enough to your 401k to get the full employer match. Second, max out a Roth IRA if you're eligible. Third, go back and contribute more to your 401k up to the annual limit. Fourth, if you still have money to invest, consider a taxable brokerage account. That sequence isn't perfect for everyone, but it's a reasonable framework, one that prioritizes tax advantages and employer benefits before anything else. And for someone starting this conversation at 40, having a framework is everything. Because the biggest investing mistake isn't picking the wrong stock. It's having money sitting idle in a savings account, earning 0.5% interest, while inflation quietly erodes everything you worked for. The goal isn't perfection. The goal is motion, deliberate, informed, consistent motion. That's what builds wealth after 40. I want to talk about something that most financial videos skip past too quickly: risk. Not in the abstract, textbook sense, where risk is just a number on a chart, a standard deviation, a percentage. I mean risk the way it actually feels when it's your money, your retirement, your future. Because here's what I've noticed: people over 40 have a complicated relationship with risk. And it's not irrational, it's earned. Some of you watched your parents lose savings in 2008. Some of you had your own accounts cut in half during that crash and spent years rebuilding what disappeared in months. Some of you have been through job losses, divorces, medical bills that rewrote everything you thought you knew about financial security. When you've lived through that kind of disruption, risk stops being theoretical. It becomes personal. And so, when someone tells you to stay aggressive with your investments because you still have time, something in you resists. Not because you're being irrational, but because you understand, at a level that a 28-year-old simply doesn't, what it actually costs to lose. That instinct deserves respect. But here's where it gets complicated. Being too conservative is also a risk. It's just a slower, quieter one. If you park everything in savings accounts and CDs because the market feels scary, you're not avoiding risk. You're choosing a different kind. The risk that inflation eats away at your purchasing power year after year. The risk that you arrive at retirement with money that looks okay on paper, but doesn't go nearly as far as you expected. Inflation has averaged around 3% annually over the long term in the United States. If your savings are earning less than that, which most conservative accounts are, your money is losing value in real terms, every year, silently. So the question isn't whether to take risk. The question is which risks you're willing to take, and which ones you're taking without realizing it. This is where the concept of asset allocation becomes genuinely important. Asset allocation simply means, how do you divide your money between different types of investments? Typically, between stocks and bonds, though it can include other assets too. Stocks carry more short-term volatility. They go up, they go down, sometimes dramatically, but over long periods, 10, 20, 25 years, they have historically provided the strongest returns. Bonds are more stable. They don't grow as fast, but they buffer the drops. They give your portfolio something to lean on when the stock market gets turbulent. The traditional rule of thumb was simple: subtract your age from 110. And that's the percentage you should have in stocks. So at 45, you'd be roughly 65% stocks, 35% bonds. That rule is outdated now. People are living longer, and portfolios need to last longer too. Many financial planners today suggest staying more invested in stocks through your 40s and into your 50s than previous generations did. But the principle behind the rule still holds. As you get closer to needing your money, you gradually shift towards stability. Not because growth stops mattering, but because you can no longer afford to wait out a major market crash. There's a concept called sequence of returns risk, and it's one of the most important ideas for anyone within 10 to 15 years of retirement. Here's what it means. If the market drops significantly in the years right before or right after you retire, and you're withdrawing money to live on, you lock in those losses. You sell low because you have to, not because you want to. And your portfolio never fully recovers the way it would have if you'd left it alone. Timing, in other words, is not irrelevant. The order in which your returns happen matters, especially near the end. This is why the decade between 50 and 60 is often called the critical decade for retirement planning. Not because the game is over, but because the decisions you make during those years carry real weight. Understanding this doesn't mean you should panic. It means you should pay attention. Because the investor who survives a market downturn, not by predicting it, but by being positioned well enough that they don't have to sell, that's the investor who comes out on the other side intact. And arriving at retirement intact is the whole point. not wealthy by someone else's definition, intact by yours. I want to tell you about a pattern I've seen over and over again. Someone discovers investing. They read, they learn, they set up their accounts, they start contributing, and then the market drops. Maybe 10%, maybe 20%. And everything they knew intellectually about long-term investing quietly disappears, replaced by one overwhelming feeling: get out. And so they do. They sell. They move everything to cash. They tell themselves they'll get back in when things stabilize, but things never feel stable enough. And months go by, and the market recovers without them. And when they finally feel safe enough to re-enter, they buy back in at prices higher than where they sold. They bought high, sold low, and called it protecting themselves. This isn't a story about other people. This is one of the most common investing mistakes in America. And it doesn't happen because people are uninformed. It happens because we are human. Because our brains were built for a world where immediate threats required immediate action. And the market, with its volatility and its noise and its headlines, triggers exactly that response. Financial psychologists call it loss aversion. The research is clear. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. So a 15% drop doesn't just feel bad, it feels catastrophic. Even when, in the larger arc of a long investment horizon, it's simply a temporary correction. Knowing this about yourself is not weakness. It's essential investment knowledge. Because the single biggest predictor of investment success over time is not which funds you picked. It's not your asset allocation or your expense ratios or how closely you followed the news. It's whether you stayed. Studies by Fidelity have shown that the best performing accounts in their database over long periods were accounts belonging to people who had either forgotten they had them or had died. Not because death is a strategy, but because those accounts were never touched, never rebalanced in a panic, never moved to cash during a rough quarter. They just sat there, quietly growing. Now, I'm not telling you to ignore your investments. I'm not telling you to be passive about something this important. But there's a difference between thoughtful, intentional adjustments and reactive decisions made in the middle of fear. The first one builds wealth. The second one erodes it. So how do you protect yourself from yourself? A few things that genuinely help. The first is automation. When your contributions happen automatically, when money moves from your paycheck to your retirement account before you ever see it, you remove the decision point entirely. You don't have to choose to invest every month, it just happens. And that consistency over years and decades is more powerful than any market timing strategy ever devised. The second is simplicity. The more complex your portfolio, the more decisions you have to make, and the more opportunities for emotion to creep in. A simple, diversified mix of low-cost index funds doesn't give you much to react to. And that's a feature, not a flaw. The third is perspective. When the market drops, and it will drop, it always does, try to remember what you actually own. You own small pieces of real companies. Companies with employees and customers and products and revenue. Those companies don't disappear because the stock price fell for a quarter. And when the economy recovers, as it historically has, those pieces become worth more again. A down market isn't only a loss. For someone still contributing, it's also a sale. You're buying more shares at lower prices. That's not comfortable. But it's how long-term wealth is actually built. The last thing I'll say here is this. Find an investing approach you can live with emotionally, not just mathematically. The best investment strategy is the one you'll actually stick to, even when it's boring, even when a friend tells you about some stock that's up 300%, even when the headlines are terrifying and your gut says to do something. Discipline in investing is worth more than genius. It's the quiet, unglamorous truth that almost no one talks about. But it's the truth that actually changes lives. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. Because what we're building here, this conversation, this community, it's for people exactly like you. People who are serious about their financial future. People who want real information, not hype. If that's you, hit subscribe. It costs nothing. And it might be worth more than you expect. Now, let's talk about the strategy that quietly separates the people who retire comfortably from the ones who don't. It's not a secret fund. It's not a hot sector. It's not something you'll find on the front page of a financial magazine. It's called a plan. Specifically, a written, reviewed, adjusted financial plan. And the research on this is striking. People who have a written financial plan accumulate significantly more wealth over time than those who don't. Not because the plan is magic, but because it forces clarity. It turns vague intentions into specific decisions. And specific decisions, repeated over time, become the architecture of a retirement you can actually live in. So what goes into a plan after 40? Let's walk through it. The first piece is your number, not a rough guess. An actual calculation of what you'll need to retire. Most financial planners use the 4% rule as a starting point. You can withdraw approximately 4% of your portfolio annually in retirement without running out of money over a 30-year period. So if you need $60,000 a year to live, you'd need roughly $1.5 million saved. If you need $40,000 and you'll receive $20,000 from Social Security, then you only need your portfolio to cover $20,000 a year, which brings your target down to around $500,000. These numbers aren't arbitrary. They come from decades of research on portfolio longevity. They're not perfect, no projection is, but they give you a target to aim at instead of a fog to wander through. The second piece is your gap. Where are you now and where do you need to be? That distance, honest, unfiltered, tells you how much you need to save each month, how aggressively you need to grow your investments, and whether there are adjustments to make to your timeline or your expectations. A lot of people avoid this calculation because they're afraid of what they'll find. I understand that. But I'll tell you what's worse than a hard number: not knowing. Because when you don't know, you can't act. And when you can't act, time keeps moving, but in the wrong direction. The third piece is your income strategy for retirement itself. This is something people underestimate. Accumulating wealth is one challenge. Turning that wealth into reliable monthly income for 20 or 30 years is a different challenge entirely. And it requires a different kind of thinking. You need to consider, when will you claim Social Security? The difference between claiming at 62 and waiting until 70 can be tens of thousands of dollars over your lifetime. You need to think about required minimum distributions from your retirement accounts. The IRS will eventually require you to start withdrawing, and the timing of that affects your taxes significantly. You need to think about healthcare, one of the largest and most unpredictable expenses in retirement, especially if you plan to stop working before Medicare eligibility at 65. None of these are reasons to feel overwhelmed. They're reasons to start thinking now. Because a decision made with 5 years of runway looks completely different from the same decision made in a panic with 5 months. Here's what I want you to take from this section. A plan doesn't have to be complicated to be powerful. It doesn't require a financial advisor, though one can help. It starts with a single honest conversation with yourself about what you want, what you have, and what the distance between those two things requires of you. That conversation changes things, not because it's comfortable, it usually isn't, but because clarity, even when it's hard, is always more useful than comfortable confusion. And you've already proven, by staying with me this long, that you're not interested in comfortable confusion. You're interested in the truth. Good. Because the truth, the whole truth, is what's coming next. We've covered a lot of ground today. Accounts, strategies, risk, behavior, plans. And I know that can feel like a lot to carry when you're walking away from a conversation like this. So let me bring it back to something simple, something true. Every person who has ever built genuine financial security, not overnight, not through luck, not through some secret the rest of us weren't told, did it the same way. Slowly, imperfectly, with more doubt than confidence in the beginning. They started before they felt ready. They continued when it felt pointless. They stayed when everything in them said to leave. And one day, not a dramatic day, not a day that announced itself, they looked up and realized the work had quietly become wealth. That's the story. In every version, across every person, that's the story. And the only question is whether it becomes yours. Here's what I want you to do when this video ends. Not tomorrow. Tonight. Write down 3 numbers. What you have saved right now. What you need to retire on your terms. And what the gap between those 2 numbers requires of you each month. Just 3 numbers. On a piece of paper. Nothing digital, nothing complicated. Because something happens when you write a number down. It stops being a fear and starts being a fact. And facts can be worked with. Facts can be changed. Fear just sits there, getting heavier. You've spent enough time carrying the weight of not knowing. Now you know enough to begin. And beginning, truly beginning, with eyes open, is the most important financial decision you will ever make. Not the best stock. Not the perfect account. Not the ideal moment. The beginning. There's something I've thought about often, and I'll leave it with you here. Money. At the end of all of this, the accounts, the allocations, the compound interest, money is just time in another form. The time you spent earning it. The time you'll buy back when you no longer have to trade hours for income. The time you'll have for the things that don't have a price tag. When you invest, you're not just building a portfolio, you're building time. And time, as you already know better than most, is the one thing you cannot recover once it's gone. So use what's left of it wisely. If this conversation meant something to you, if even one idea landed in a way that changes something, share this video with 5 people in your life. Not to promote a channel, but because someone you know is sitting with the same quiet unease you came in with today. And they deserve to hear this too. Subscribe to Bedrock Money if you haven't already. We show up here regularly with the same honesty, the same depth, and the same respect for your intelligence. And leave a comment below. Tell me honestly, where are you right now? Just starting? Somewhere in the middle? Or closer to the finish line than you expected? I read them. Every single one. And if there's a topic you want us to tackle next, a question you haven't been able to find a straight answer to, write it down there. Because the next video, it might be yours.